In this video, I'm going to work exercise 16.9. It's on page 16-43 in your textbook. As usual, I'm going to drop down to the instructions and see what I'm supposed to do. Letter A says prepare a budget report based on flexible budget data. So that means I'm going to prepare a flexible budget. And I'm going to prepare a budget report with that flexible budget, means I'm going to be comparing that flexible budget to the actual results. And then letter B is to make a decision, right? Should Joe have been reprimanded? And explain. So once we do letter A, we should have the answer to letter B with a little thought. So let's go back up to 16.9 at the top. It says, as a sales manager, Joe Batista was giving the following static budget report. Now, a static budget report compares the static budget to the actual results. So Joe was given the following static budget report for selling expenses in the clothing department of Soria Company for the month of October. So we're dealing with expenses only, although we could do a budget report with revenues also. But here in this problem, we're just doing expenses. So this is a table with some expenses in it. And what I've done, as you might guess, is I've copied that table over into an Excel file just to minimize the flipping back and forth between the problems on the screen. So this is just a copy of what's here. So if you want to pause the video and set your own Excel file up, you can. It says, as a result of this budget report, Joe was called into the president's office and congratulated on his fine sales performance. So they had budgeted 8,000 sales units and they actually had 10,000 sales units. So, hey, you did better than expected. So, yeah, you're going to get congratulated for that as the sales manager. He was reprimanded, however, for allowing his costs to get out of control. You see that they budgeted $8,230 of variable cost and they actually had $8,950 of variable cost. So the variable costs were higher than expected. The fixed costs were identical. And so the total costs were higher than expected. So the president's like, Joe, you beat the sales goal. We expect you to sell 8,000 units. You sold 10,000 units. So congratulations. But you spent more money than you should have, right? The budget for these variable costs, you were budgeted $8,320. You spent $8,950. So your costs are a little out of control there, right? You got to get those costs under control and keep them within the budget. And so Joe comes to us for advice, wanting to know, hey, what should I do? So the first thing we're going to do in letter A is prepare a budget report based on flexible budget data. So let me go over to the Excel file. The problem with the president's analysis about Joe not being able to keep costs under control is that the president is comparing apples to oranges, so to speak. The static budget, the original budget, was prepared with a projection of 8,000 units sold. The actual results were 10,000 units sold. Now, the problem with that is that when you sell more items, you would expect the variable costs to go higher. I mean, that's what it means to be a variable cost. A variable cost is going to increase with changes in production and sales. So if we sell more items, I would expect variable costs associated with selling, like sales commissions and advertising, I would expect that to be higher because that's what it means to be variable. The total is going to move when the sales number moves, sort of like in production. Direct materials is going to be higher when I produce more than I expected because direct materials is variable. The more units you make, the more money you spend on materials. So the same thing here on the sales side, right? The more I sell, the more sales commissions I'm going to have to pay. The more I'm going to advertise, the more I'm going to be doing traveling related to sales, the more I'm going to be doing free samples related to sales, perhaps, right? So variable costs change when the activity level changes. And that's why comparing 8,000 units to 10,000 units of actual results doesn't really make a lot of sense because the fact that I sold more than I expected leads me to automatically assume that my variable costs are going to be higher than I expected. That's not necessarily a bad thing, right? We want to sell more items. So I'd love to see my variable costs go up as long as they're going up because I'm selling more items. I mean, that's the whole idea. So what we need here is to prepare a flexible budget report, which is comparing the actual results to a flexible budget, not the static budget. So to create the flexible budget, I'm going to bring this static piece and I'm just going to copy it over here and look at it for a minute. Let's talk about the static budget that was originally prepared. You can see the data here on 8,000 units. What I really need to know to do this problem is I need to know the per unit cost for the variable cost items. So in other words, I budgeted sales commissions to be $2,400, and I know sales commissions is a variable cost because the more my salespeople sell, the more I'm going to have to pay them in terms of commissions. And I actually want to pay them more in commissions because I want them to sell more. So this is a good thing. But the 2,400 has to be connected to the 8,000 units sold because it's variable. Variable costs have to be connected to the activity level. Otherwise, they wouldn't be variable. So to find out the per unit amount for the sales commissions, I'm going to take the sales commissions of 2,400 and divide by the 8,000 units to calculate how much in sales commissions am I paying for each unit sold. And when I do that, I will get 30 cents. So let me do the deal here, get this formatted up for accounting. We're going to go no there, and we'll go here and here with a dollar sign. So the sales commissions must be 30 cents a unit. Remember, variable costs are constant per unit, and they vary in total. So the fact that I'm budgeting $2,400 of sales commissions on 8,000 units, and I know that sales commissions are variable, means that there must be some per unit connection between the sales commissions and the sales. In fact, there's going to be that same connection between all of the variable costs and the sales. So I'm going to rinse and repeat this. And in fact, let me do it this way. Let me put in some dollar signs there to hold this constant, and then I can just drag and drop it. So the advertising here is $720 on 8,000 units. So if I take 720 divided by 8,000, I'll get 9 cents per unit of advertising. The more I advertise, the more I sell. That's the general idea. Travel, $3,600 on 8,000 units. I divide those, I get 45 cents a unit. And then free samples, $1,600 on 8,000 units gives me 20 cents a unit. The per unit data is the critical part that you have to get to in order to figure out the flexible budget. So the total variable cost, I don't really need to know this, but the total variable costs are just the sum of those four numbers. And if I highlight those and look down at the bottom of the screen, you'll see that at the bottom of the table, it says sum is $1.04, which is correct. Now notice I'm not going to do that for fixed cost. I'm not going to do the per unit for fixed cost. And the reason is because fixed costs don't change when the activity level changes. By definition, fixed costs are fixed. They don't change in total. Just because I sold 10,000 units instead of 8,000 units, that's not going to cause the fixed cost to change. Changes in volume do not cause fixed cost changes by definition. So I am not going to compute per unit data for the fixed cost. So now how do I change this? Let me come back over here on the left. How do I change this now to a flexible budget? Well, I want the flexible budget to be for the same 10,000 units as the actual results. So that's going to make the variance here 0. Okay. Now, for the sales commissions, I'm going to take the 10,000 units hang on. I'm going to take the 10,000 units and I'm going to multiply by the 30 cents sales commissions per unit. So in other words, if I had known back when I made the original budget that we were going to sell 10,000 units, I didn't because I made the budget for 8,000 units. But if I had known back when I made the original budget that we were going to sell 10,000 units, I would not have budgeted $2,400 for sales commissions because sales commissions is a variable cost. At 30 cents a unit, I would have budgeted $3,000 for sales commissions because that's what you would do with a variable cost budget. You would say, okay, we pay 30 cents in sales commissions for every unit sold. So when we create this budget, our sales commissions is going to be dependent upon how many units we think we're going to sell. Now, we originally set that up for 8,000 units because that's what we thought we were going to sell. So 8,000 times 30 cents is $2,400. But when we got to the end of the month and we got the good news that we actually sold 10,000 units, that means our 8,000 unit total for sales commissions was wrong because we know we pay 30 cents a unit. There's no way we pay 30 cents a unit and we sell 10,000 units that we can expect sales commissions to be $2,400. We can't do that. So in order to get an accurate comparison as to how well Joe was really controlling the cost, the first thing we need to do is to set up a flexible budget where the units are equal to the actual results. And then recalculate the variable cost based on the per unit data. So I'm just going to drag and drop this. And you can see here, let me get rid of the dollar signs real quick, since it's going to bother me if I don't. And then get that thing underlined the way it should be. Okay. You can see here that the advertising is going to be 10,000 times 9 cents. So that's the $900. The travel is going to be 10,000 times 45 cents is $4,500. And the free sample is 10,000 times 20 cents, which is $2,000. And those numbers added together should be $10,400. So if we had known that we were going to sell 10,000 units, this in column B is the budget we would have set up if we had known what the sales volume was going to be. That's exactly what we would have created. It's using the same assumptions that the original budget used, which is our variable costs are 30, 9, 45, and 20 cents per unit based on the activity, the item. And our fixed costs are those amounts because they're fixed and it doesn't matter how many we sell. Rent's $1,500. It doesn't matter if we sell 8,000 units, 10,000 units, 4,000 units, 15,000 units. It doesn't matter. It's $1,500 because it's fixed. Now we have apples to apples. Now I have a budget based on 10,000 units sold, and the actual results are based on 10,000 units sold. So now I can compare the cost with a higher level of quality analysis because I have the sales units identical. We could prepare a flexible budget for any number. I mean, in this problem, I prepared it for 10,000. We could prepare it for 9,000. We could prepare it for 15,000. We could prepare it for 2,000. We could prepare the flexible budget for any level of sales we wanted to. We would use the exact same thing that I did. We would start out with the per unit numbers, and the sales commission is 30%, 30 cents per unit. So if you wanted to do a flexible budget for 2,000 units, you just take 2,000 times 30 cents and you'd get $600. And you do the same thing with advertising, travel, and free samples. And then your fixed costs would not change. Your fixed costs would be $1,500, $1,200, $800, and $500 because fixed costs don't change just simply because you sold more or less than some other number. So we could do a flexible budget for any amount. There's an infinite number of flexible budgets we could do. But the flexible budget that has the highest use is the one that is identical to the actual results in terms of the sales volume. In this case, that's 10,000 units. So now that we've got the correct budget in place, and this would be a flexible budget report that I have here. So let me highlight this for you. This is the flexible budget report. All we need to do now is go through and compute the variances. So there is no variance for the sales units because 10,000 minus 10,000 is 0. The sales commission variance is going to be $400. It's 3,000 minus 2,600. Now I got to think about this. The actual sales commissions were less than what I'd planned in the flexible budget. Sales commissions are an expense to me. They're a cost, right? It's a cost of running the business. So it makes income go down because that's money I'm paying to my salespeople. So when I'm spending less than I expected, that means I'm going to have more profit in my pocket at the end of the month. So this is a favorable variance because I'm spending less than I thought. The advertising, the variance is going to be $50, 900 minus 850. Again, I'm spending less than I thought, so that's going to be favorable. The travel, I'm spending less than I thought, so that's 400. That's going to be favorable. And the free samples, I'm spending less than I thought. That's going to be 600, so that's favorable. And the total here is going to be the sum of these four numbers, which is going to be 1450, favorable. Now notice there is no change in the fixed cost. The fixed cost variances are all 0 because a fixed cost variance cannot be changed or cannot be caused by changes in volume. Okay? Fixed costs can change, but they can't change because we sold more or less units than we thought. So down here at the bottom, these are going to change. So I have a $1,450 favorable variance for total variable cost. The total fixed cost variance is 0 because the fixed costs are identical. And so down here, this is going to be the same number. This is going to be 1450 favorable. And so here's the correct flexible budget report that the question asks for in letter A. So should Joe have been reprimanded? Absolutely not. Not only did Joe sell more units than was expected, but he also kept all of the cost across the board underneath what you would have expected him to spend given 10,000 units of sales. So the answer to letter B is no, Joe should not have been reprimanded for the reason I just gave. All right, that's it for exercise 16.9. Let me know if you have questions.